Hello, welcome to Lecture 3. Our today's discussion is review of financial ratios, or in other words, you can say interpretation of financial statements. So let's see what are the objectives of this lecture or this chapter. The main purpose of this chapter is to provide a framework for analysis of financial data in order to write a report. So as we all know, we have a coursework 1 on evaluating the financial performance and quality of the reports. So this chapter will help us to evaluate the financial performance of the companies and report on those. So specifically, we would be able to appreciate the potential of ratio analysis as an analytical tool. We will see the initial overview of the financial statements. We would be able to discuss the relationship between different ratios and financial statement of a single company, and we would be able to compare the financial statement between the periods and one company with the other. And also, finally, we will see some sorts of limitations of ratio analysis. So the first part, we will see how we can compare the ratios, compare the financial statement, interpret the ratios. So first thing we need to remember in case of comparing the ratios, comparing our financial performance of one period to the other or one company with the other, we should compare the companies which are alike, which are similar. So what we can do, we can compare the financial ratios of a company, of a firm, with the financial ratio of that firm in a preceding year, preceding period. So if we calculate the financial ratios, for example, 2020, and then you can compare with the ratio with 2019, 2018. And also we can compare the actual financial performance, actual financial ratios with the budgeted financial ratios, expected financial ratios, what we actually expected and what we actually achieved. We can evaluate the performance in that way as well. Financial ratios for other profit center. So for example, if you want to compare the financial ratios of one branch of the company with another branch of the company, and financial ratios of different subsidiaries within a group of company, we can compare that as well. So as a group of company has, say, 4 or 5 or even more can be subsidiaries working under one group, and then we can compare the ratios of these subsidiaries to evaluate which subsidiary is doing better and which one is not, and what are the reasons. So the important message of this slide is we can compare if the companies are alike, if the companies are similar. We can't compare something extremely different. We shouldn't do that. For example, in our coursework, what we will compare two different water companies. That is, these companies are kind of similar and working in the same industry, so they are similar. Why we need to do that? Um, Uniformity. So comparison is possible only if there is uniformity in the preparation of accounts. So the accounts that we are comparing should be similar, should be prepared based on the same financial accounting standards, right? And if not, if they are not following the same financial accounting standards, in that case, we should remember what are the differences. So, for example, in US, Securities and Exchange Commission still has not adopted IFRS. So, the companies which are following Securities and Exchange Commission's rules and regulations in preparing their financial statement, if we want to compare those companies with the company which is following or applying IFRS, we should bear, bear in mind what are the basic differences in the financial reporting standards. What differences can happen? So in case of analyzing the financial performance, we should remember those things. Um, so in different way we can prepare. Uh, we can analyze the financial statements. We can interpret the financial statement. So one of the approach is common size um, statement of financial position, common sized. So we can prepare the income statement or balance sheet in a way. So say we prepare the common sized statement of financial position of two different companies, but the financial position may not be same, the companies that we are comparing. So in that case, if we represent the numbers in common size, that is within 100%, within 100%, in that case, the number would be comparable. We will see in a slide after. So a vertical analysis which assess the strength of the financial position with assets liabilities as a percentage of a base figure. So we will compare the percentage of say current asset of company A and the percentage of current asset of company B. So the percentage is same. So we can say current asset of company A is say 30% and company B has 35% of current assets. So you can compare. But if you want to compare the numbers, that is not that may not make sense. For example, one company is big, the other company is small. In that case, if you want to compare, so in that case you will say company A has 5 million pound of current asset and company B has 100 million of current asset. So 5 million and 100 million you can compare. So in that case, how we are representing the current asset or any other asset, just I'm using current asset as an example. So how can we compare with the same or similar number? So we are representing the current asset in percentage term, fixed asset or non-current asset in percentage, or liabilities in percentage. So the percentage of one company can be compared with the percentage of current asset with the other company. So that would be comparable. This is what we call common sized financial position statement. And then a horizontal analysis is being carried out to find out, to do some further investigation. So if there is any area that we need to investigate further, if there any area where we can see a bigger change within that particular company, that we can do after preparing common sized financial statement. So, and then a vertical analysis, common size statement. This is what we can do as well. Vertically, the analysis is being done vertically, up, down. The vertical analysis is an approach which highlights the structure of the statement of financial position. So how we show our assets and liabilities from up to down. So non-current assets, working capital, debt, equity, expressed as a percentage of debt plus equity. So if you didn't understand, so this means we will represent the figures in terms of again in terms of percentage. So what's the total assets and what percentage is the non-current asset? What percentage is the current asset? What percentage is the other figures? So total equity and liabilities together is 100%. And then what percentage is the equity? What percentage is the working capital or debt? So this is how we do a vertical analysis. So they represent the numbers based on the based on 100%. So the total asset is 100%. Total liabilities and owner's equity altogether is 100%. And then represent other numbers based on the whole percentage, 100%. So you can see here, if you didn't get the picture clear, theoretically as we discussed in the previous slide. So this is what I mean. So you can say these are the real numbers of 2008 or 2018, and these are the percentages of 2018, right? And these are the uh, real numbers or figures in thousand in 2019, and these are the percentages of 2019. And you can see here total asset is 100%. All right. And then out of these 100, what percentage is the current asset? Is 69.5. And what percentage is the current asset? Is 30.5. All right. So how we have calculated this percentage in terms of the total assets? All right. So how did we get 69.5? So 3,021 divided by 4,042 4,342 multiplied by 100. All right, then you will get 69.5. For current asset, 1,321 divided by 4,342 multiplied by 100. And then you'll get 30.5. All right, so the same way we have to calculate the percentages for liabilities, debt, and equities as well. So the total is obviously 100%. Then calculate the percentage for equity. 3,262 divided by 4,342 multiplied by 100, and you will get 75.1. All right. And in case of debt, 600 divided by 4,342 multiplied by 100, you will get 13.8. So similarly, we did others and for 2019 assets and liabilities as well. So if we do it, and then we can see, we can make a vertical analysis, and then we can see what is the changes between the years. So for example, in case of current asset, what happened? What's the change from 2018 to 2019? In 2018, current assets were 69.5, and in 2019, we can see 61.8. Right? So what percentage a particular asset and liability represent in the specific financial year? We can see that as well. And at the same time, we can compare between the years. So what is the changes between the years? So this is what we call horizontal and vertical analysis. And this is actually mean the common sized financial position statement. So this is common size. So we are representing in a single size, common size that is within 100. So you can compare these common size financial statement for two different companies, and then you can compare as well. So we are doing here 2018 and 2019. You can say this is for company A and this is for company B, and then you can compare as well. horizontal analysis. A horizontal analysis looks at the percentage changes that has occurred. This is what I just show in the previous slide. So between the years. So concentrate on the areas where you need further look, where we need further investigation, right? So what is the changes between the years? What was in the last year and what happened in the current year? Or what happened in current year and what was the situation in last year? We can compare and then we can further investigate what is the reason. Why sales reduced? Why profit decreased? Why, say, salaries, expenses significantly increased? So this is what we can do some further analysis. Uh, and if you see why we need to investigate further, so we can see the percentage changes between the years. So, uh, for example, if we analyze the current assets of a particular company for 2018 and 2019, we can see the changes between the figures. And if we calculate the percentage change, how we can do it? So we have to find out the difference first. So 563,000 minus 398,000, then you will find the difference divided by the preceding figure, the earlier figure, 398 multiplied by 100, and then you will get the percentage change is 41.5. And it's a positive change because 2019 figure is higher than 2018. So similarly, you can calculate for the trade payables and you can calculate for bank overdraft. And if we see the changes, right, a biggest change is in case of overdraft, bank overdraft. And this is 136.6 percentage increased. And obviously, this is not a good sign for a company to get a larger amount, more than 100%, 100 and around 1.55 times increased of overdraft. So we need further investigation. What was the reason? So 41.5% inventory increased. Obviously, it has some significance. It has some implications on the profitability of the company, right? So if your inventory increased, what does that mean? It tied up a larger amount of capital in the store, right? So if you have lots of capital tied up in inventory, then on that figure, on that capital, you are paying interest to the bank if you borrowed money. So it has implications. So we need to further investigate what is the reason. Do we need that much inventory? What actually happened to the bank overdraft? Why we had to borrow a larger amount of money from bank? So this is what we are saying. This is a horizontal analysis for further closer look of that particular issue. And we can do the same thing for same kind of analysis for income statement, not only for balance sheet or financial position statement. So preparing a common sized statement of income statement that we can look at the structure of income and expenses of the organization. Which income, which sources of income is significant for the company? Which areas companies is spending too much money that we can um, find out more specifically from common sized um, income statement or profit and loss account. So if we see this example, sales figure changes between the years, cost of goods sold changes between the years, and distribution of cost, distribution cost changes between the years. So what is the percentage? Sales is 100%. As we always will think, in case of income statement, we will recognize sales as 100%. And in case of balance sheet or position statement, as we showed before, so the total amount, total assets is 100%. total liabilities and debt and equity all together should be 100%. So, and then we will calculate what percentage is the cost of sales. So how can we find this 68%? So 2,240 divided by 3,296 multiplied by 100, then you will get 68%. That means the cost of sales is 68% of sales. That means if you sell 100%, 100 pound, then your cost is 68 pound. Cost of sales is 68 pound. Distribution cost is 11 pound. So how did you get this 11? 365 divided by 3,296 multiplied by 100. And then you can do the same thing, similar way for the next year. And then you can, so this is how we can see the significance. So from sales, what percentage of the cost, significance of the cost of sales in terms of cost of sales in terms of sales, right? And in the next year, what we can see? We can see the cost of sales significantly increased and distribution costs significantly decreased in terms of percentage. If you compare between the years and if we see the significance of the cost in that particular year. And based on this kind of horizontal analysis, comparing between the years, we can see the trend of changes of the figures. What is the trend, right? How it changes. So, for example, we can see gross profit 5% decreased, and distribution cost 37.5% decreased. So this is what we can see how organization is going forward, and if we compare one year to the other. Um, Overview of this is what we already did, and we can see how we can calculate. I already explained those horizontal analysis. Previously, it was just showing vertically. Now this is what we see the changes between the years, right? So how can you calculate this 5%? So we have to find out the difference between the years, and then so that means 3,461 minus 3,296 divided by 3,296 multiplied by 100. So you will see 5% change, right? So this is how we have to see horizontal analysis. We have to find out these changes in the figures, and this is how we can interpret the financial statement, analyze the financial statement. It can be common size financial statement, it can be horizontal analysis, it can be a vertical analysis. In different way, we can see the performance of the organization in different perspective, in different issues, how organization is doing. So if we want to analyze the individual figures, right? Analysis of the percentage changes in individual expense, this is what we can do. And it's the same thing. It's the same thing. It's a similar way as I discussed before for other figures, cost of sales or distribution expenses. This is kind of the same thing. We can see or we can analyze individual items if we need further look, if we think, oh, there may be something wrong with purchases, there may be something wrong with inventory, can we just see what actually happened there? And then we can do individual items analysis as well. And we can see here inventory, closing inventory is 41% or 42% change increased. So it has implications on profitability and capitals and asset structure of the organization. So if we store larger amount of inventory, right, as I mentioned before, it has lots of capital tied up, and also you have to pay interest. At the same time, you have to pay go down rent, right? Lots of significant expenses in that on that particular expense. Stress testing. So this is what we we can analyze if we see the changes in the figures, and then we can analyze some sensitivity analysis, right? This is what we call sensitivity check or sensitivity analysis. So sensitivity analysis is actually mean if then what. If something changed, then what are the implications of that change to other figures? So for example, if sales increases, what will happen to the profit? If raw material expense increased, then what will happen to the production cost? If labor cost decrease, overhead cost increase, what will happen to the profitability? What will happen to the production cost? What will happen to the performance of the organization? This is what we call sensitivity analysis. So what is if? So there were to be a fall in sales, say 5%. If the sales decrease 5% in 2019, then what will happen to the profitability, right? So why sales decrease? If we cut advertising budget, then sales decrease 5%. Then what is the implications of this 5% decrease of sales on the operating profit and interest cover of the organization? So that's up to the introductory analysis of the financial statement, interpretation of statements in different way, like horizontal, vertical, and common sized. And in the next part of the video, I'll discuss about the ratios, specifically the ratio analysis part. So see you there. Thank you very much.